120, revenue, NOI, and cash-on-cash returns. This is the 39.6 Facebook and YouTube Live Finance Show, a show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. We are going to continue discussing multifamily financials. A little bit more nuts and bolts. Some things I've already touched on, but just to kind of have it all in one place, we're going to discuss revenue, net operating income, and cash-on-cash returns. Okay, I'm going to see if my screen share will work. Hopefully it will. Because I've had a lot of issues with this. But please, if you see the screen, please let me know that you can see my screen. Yes, I am up late. We have been watching, or I've been watching TV. I don't ever watch this much TV. There's nothing else going on in the world right now. All right. Anybody see the screen with my Excel spreadsheet? Please let me know. The previous episode, it did not show up for a few minutes. Okay. Now, if I go to split screen, do you still see it? Okay, I hope so. All right. So this is a very simple Excel spreadsheet, very weaned down to just a handful of line items. So let's pretend you're purchasing a property, a $1.5 million property. This could be like, I don't know, it could be like a 30-unit property at $50,000 per door. Could be a 75-unit property at $20,000 a door. Not really many of those anymore, but there were a bunch a long time ago, back when I was in med school, like the one that I lived in. Okay, so you buy a property at $1.5 million. Let's just assume that you're putting just 20% down. For round numbers, I used $300,000, and that you want to have $50,000 of cash reserves that you need to have for capital expenditures, or just to have cash at the time you purchase this property. So your total cash outlay on the front end is $350,000. Okay. Now, you rent out the property, and it brings in a total of $110,000 in rent per year. Okay. Now, when you look at the financials of a multifamily property, actually, it usually has a few more line items. It'll have like gross potential rent, and then the loss to lease, and you would subtract that to get your rental income. Potential rent would be like the market rent, and loss to lease would be how much you're renting it below market value. Okay. But in the end, you'll have rental income. Then there's other income. You can charge tenants for a lot of other things. Okay, so for example, if you want to have a reserved parking spot, or covered parking, or storage units, pet rent, laundry, those are all things that would go under the other income category. So let's say you bring in the $10,000 of other income. So combined, you have $120,000. Now, make that a little bigger for you. Okay, there you go. $120,000 of income, and you invested $350,000 in cash. That would be fantastic. That's about a 1/3 return on your money, except you haven't paid for any of your expenses yet. So you have to pay for all of these expenses. So when you are running a big multifamily property, you're usually having staff on site all the time. So, or let's say part-time, but you have people who are on payroll. Okay, so that's one line item. I have that listed here at $13,000. Okay, that's around 9%. Okay, general and administrative, or G&A, that's $4,000. Okay, G&A could include a lot of regular things, just like the office and the leasing office, for example. Expenses, phone, internet, stuff like that. Okay. Property management, here's around 3% or so of the rental income. or of the total income. Marketing, advertising, and retention of tenants, 2,000. Repairs and maintenance, or R&M, as people call it, 2,000. Contractor services or contract services, this could be like landscaping contract services, or the pest control, for example, if you're living in states that pest control is an issue. I mean, really anybody. But there you go, things like that, or alarm services. Then we have turnovers, or make-readies, basically between renters, between tenants, utilities, insurance, and real estate property tax. Okay, so, and that's at here, 1% of the total price of the property. Here in Texas, that's often 2% plus. In other states, it's often like 1%. It highly varies. But here, your total expenses are $55,000. Now, when you take your total revenue, okay, so your total revenue is your rental income and your other income. That's $120,000. Your total expenses is $55,000. Those are all of the expenses that would be considered like tax deductible expenses. These are not inclusive of debt service. Okay, so that's $55,000. That gives you a net operating income. Okay, so that's revenue minus expenses. 120,000 minus 55,000 equals $65,000. Okay, so the net operating income, or your NOI, that is like the one most important number to keep track of when you're looking at financials, because that is how the value of the asset is determined. Now, remember, we have not taken into consideration the debt service. The debt service is the amount of money you pay to the mortgage. Okay, now, this property, we took out a $1.2 million loan, and assuming you're getting this at nice 3% interest rates that are available right now, and you're paying interest only for a number of years, that's just $36,000 per year in interest on $65,000 of net operating income. Okay, so that $65,000 over $36,000, that proportion, that's called your debt service coverage ratio. We previously discussed these back in a previous episode. Like, just lost it. Sorry about that. Okay, and then you have a debt service coverage ratio of 1.81. Okay, let's see. I thought I had this right in front of me, but what episode was that? Yeah, episode 52, when I covered debt service coverage ratio. Now, that is basically showing the proportion of your income versus the debt. And if it's less than 1, you are cash flow negative. You can't service the debt. If you're above 1, you can service the debt, but you're not going to get qualified for a mortgage if you're only like 1.1, just barely cash flow positive. It has to be like 1.25, 1.3, for example. So you have some space there. Now, the cash flow, or the positive cash flow from the property, is your net operating income minus your debt service. Okay, so $65,000 minus $36,000 gives you $29,000 of cash flow. So that's how much money you have left over after paying all of your expenses and paying the mortgage off, that $29,000. Now, you invested $350,000 of cash on the front end. You take that $29,000 divided by $350,000. That will give you your cash on cash return. That's the cash back to you divided by the cash that you put into the deal. And here you have 9.7%. Okay, so let's see. Make sure I put that right. C35 over B6. Okay, actually, I should do it over. Sorry about that. Equals this number divided by that number. Okay, 8.3%. I had just divided it by the down payment earlier, so that was why it's a little bit too high. But if you include the entire capital that you put into it, including capital expenditures, on this example, you have 8.3%. There you go. So total revenue is all of your income, rental income and other income. Net operating income is your total revenue minus all of your, basically your tax deductible expenses. And then your net operating income minus your mortgage payment equals your cash flow. Cash flow divided by invested capital gives you your cash on cash return. All right, there you have it. Nuts and bolts lecture for today. Oh, hello, there's Vina. All right. I was like, I have one viewer. Who is it? Is it my wife? No, it's Vina. All right. That's it for tonight, episode 120. Until episode number 121 tomorrow. This is strictly for my entertainment, hopefully yours. Not legal, not professional, not accounting, or any other advice. Please consult your professional advisors, accountants, etc. before making any of your own financial decisions. Have a good night.